Hello, Lorenzo Carver here from Liquid Scenarios with a brief video that attempts to explain how Fidelity's October 2011 investment in Workplace grew at a 1,600% annual growth rate compounded, while Workplace's common stock appreciated at a compound annual rate of just 93% during the same exact period. While both 93% and 1,600% are awesome rates of growth, the big issue here is just the magnitude of the differences in valuation between what Fidelity's SEC filings suggest and what Workplace's 409A valuation implies. It's a difference of billions of dollars. But as Bambi Francisco pointed out when we were discussing this, it's not that there's a huge difference in the values. It's who's impacted by that difference. That's important. So limited partners and venture funds like New Enterprise Associates, all of Workplace's employees that hold stock options, tons of retail investors in Fidelity's Contra Fund, and ultimately retail investors that purchase shares of Workplace in the aftermarket following its IPO would all be impacted by such a large difference in valuations this close to a public offering. Because of that, it's important to clarify that this huge difference in valuation appears to exist based solely on my interpretation of information filed with the SEC by Fidelity's Contra Fund and information filed by Workplace in its registration statement. In this article, I'll walk you through the disclosures and calculations leading to that interpretation with sufficient detail to allow you to draw your own conclusions. And in following articles and posts on this subject, we'll dive into that detail a little further. The starting point for the analysis is actually Fidelity Investments Contra Fund annual report for the year ended December 31st, 2011. In that report, Fidelity reports holding 1.2 million shares of Workplace valued at $29.9 million, roughly $30 million, or about $24.50 per share. This compares to the acquisition price reported in the audited financial statements from the same filing, which states a cost basis of $16.23 million for Workplace shares the mutual fund acquired on October 13, 2011. Since October 13, 2011 matches approximately the press reports for Workplace's Series F financing when it closed, dividing the acquisition price reported by Fidelity by the year-end shares equals the Series F issue price recorded in Workplace's charter to the penny. Dividing the December 2011 value by the October value, then subtracting 1, suggests annualized appreciation of 84.77% for Fidelity's Workplace investment over the 79-day period. An 84.77 gain over 79 days, depending on how you calculate it, suggests a 1,600% return compounded annually. This compares to the valuation that Workplace used to grant stock options, which was just $4.25 per share in October of 2011 and $4.90 per share for shares granted in January 2012 based on their estimated December 2012 value. A difference almost always exists between common stock fair market value determined for IRS 409A rules and the fair value funds report to their investors for the same companies. Many times these differences reflect superior claims to the company under poor or mediocre sales scenarios due to liquidation preferences and other rights. Also can reflect differences in valuation standards and sometimes differences just in objectives according to some people, which would say that under certain circumstances the valuator wants a higher number, under certain circumstances the party getting it done wants a lower number. However, the issue here again is not really was there a huge difference in the values they came up with, but rather the huge difference in the value change over the same short time period. So what plausible factors help explain this huge difference? In the next post, I'll illustrate a few simple explanations, beginning with differences in assumptions concerning growth, differences in assumptions concerning the rate of return investors would require, and as a result of those prior assumptions, differences in expected volatility between what Workplace's board and Workplace's 409A valuation firm relied upon compared to the variables that Fidelity may have relied upon in reaching their value conclusion.